All right. Hello, everybody. We are just a few minutes away from a pretty big decision from that man right there, Mr. Jerome Powell. And we're going to see what he's ready to do, what he's ready to say. I'll probably turn this off right now. We have a couple of minutes, 5 minutes, really, till we get the results right now from the FOMC. So we are going to be getting it in real time. And then at 2:30, he goes live and he has a lot to say. Let's open up the stock market Webull and kind of see where the charts are at right now and see where the charts are going. This chart is going to give us a lot of volatility and movement in the next 5 minutes. We get a decision in 5 minutes. We will know what he's doing. Midwest Dam has to leave out of your last vid for this. Yes, thank you for being here, Midwest. Johnny, D. Edwards, Bot 101, Jude, Ray, Tortune, ADJ. We're going to see how the market reacts. I bought a little bit of end phase today. Saw the end phase going down pretty aggressively below 170 at one point. I bought a little bit of end phase. So I know Johnny will be happy about that. If it tanks tomorrow on earnings, then that's great. Another time to load up. If it keeps going, that's awesome. We will see what happens for that. Stefan, what's up? M. Russo, what's up? Just left the Traveling Traders stream. Thanks for being here, Amit. Who is the Traveling Traders? I've never heard of these guys. Thank you for being here, sir. Traveling Traders. Oh, cool. They have a cool channel. They do a ton of trading stuff. Okay, awesome. Thank you for being here. I appreciate it. It means the world to me. So we're going to see now what happens. Hello from Germany, Rainer Camps. Hello from Germany. Put where you are watching in the world in the chat, please. Would mean a lot to me. Kevin, bro, I just saw your message on Twitter. The thing is shipping out today, so you will get a tracking message today. As Kevin knows what I'm talking about, so you will get a tracking message today from me today, and it will be shipping out, and then you will see it tonight. It's been just a super busy 2 weeks, but you're going to be getting that tracking number tonight. What happened to Jerome on TV? We're going to turn him on in a second. I'm going to get him back on. But he will be announcing in 3 minutes what we got. We got Houston in the house. Colorado, California. There's a place in California called Colorado? Interesting. Okay. We got France, North Carolina, Belgium, David Jung, thank you for being here. Hawaii, Arizona, Columbus, Ohio in the house. Canada. All good, homie. Okay, awesome. Awesome. You'll be getting it soon. Hopefully like in a week and a half on UPS. You should be getting it. I left the Meet Kevin stream to watch him. Let's go. I love Meet Kevin. But yeah, we're doing our own thing here on my channel, that doesn't have 1 million subscribers, but we're doing what we got to do. Okay, we're doing what we've got to do. Snapchat has fell 18%. Would it be wrong of me? I know I shit talked the crap out of Snapchat today. I'm kind of thinking, is there any value in having a little position in Snapchat? I mean, the stock's down 18% on the day. How much lower can it really go? Now, yes, it can go lower. There's strong support at 7. Definitely not buying Snapchat at all. Just started thinking about it a little bit more, trying to be a little contrarian, like, could this thing just pop back to 15 when the market, tends to get back into a little bit more of a bull cycle? Again, not buying it. The fundamentals of the business are absolutely dog shit. It's garbage. The stock-based compensation is just ruining shareholder appreciation, on top of the fact that they're losing so much money. But it could be a similar thing to Spotify, where Spotify also is down aggressively today. Is it up? Yeah, it's up 5% today, just because when the stock falls that deeply, there are some buyers and there's ready to be a little bit of recovery. So not buying Snapchat, but just looking at some of the price action there. What do we have? Montreal, TJ the Wheel deal from my washroom. Okay, well, however you want to enjoy it. We have a minute until market open. India, Puerto Rico, Houston, Texas, Canada, Germany, Buenos Tardes. That's not a place. You're actually saying good morning. No, good afternoon. I did not do good in Spanish. But good afternoon to you as well. Fresno, California, Norway, Bay Area, California. I love it. I used to have a girlfriend back in the Bay. Got some good memories down in Palo Alto area. Very expensive area, but San Francisco Airport, one of my favorite airports in the world. I love SFO. SFO is great. Just got a survey work from DoD asking about my opinion on using AI in the workplace. That's what I'm talking about. A little Palantir, know what I'm saying? Palantir earnings coming up soon. All right, so we got 30 seconds until we get this decision. I'm looking at stocks right now. Let's pull up to the S&P 500. Let's see the movement there in real time. It's down 0.26%. Literally in 30 seconds, we should be getting a decision. 30 seconds, we should be getting a decision, and we will know what is going on. unless I'm wrong about it being at 2 p.m. But I'm pretty sure, yeah, it's at 2 p.m. The thing is at 2:30, so we should get a decision pretty quickly, and we will see what's going on. Washington State, I love it. South Africa, amazing. The UK from Elon's bathroom stall. Think I'm gonna buy Snap. Proceeds to call the stock target. I'm not gonna buy Snap. I'm not. I was just looking at from the chart. I was like, is there a bounce on Snap that you could do for a quick trade? But yeah, it would be a trade. It would not be an investment. It would absolutely not be an investment. Snapchat is, if you're investing in Snapchat versus all the other opportunities we have, I think you're a little kooky there. You're a little kooky. From that weird Austin, Texas. Awesome. Finland, amazing. Amit, show me proof you bought Enphase. I actually bought Enphase. I bought some Enphase today. Not a lot, but I bought some Enphase. It was below 170, so I got excited below there. No rate hike? You're lying, Johnny. There's no way. There's no rate hike. Goodness gracious. Could you imagine there's no rate hike? All right, so here we go. We got 25. We got 25%. There it is. It is here, 25%. What's the market doing? 25% confirmed. The market is pretty much unchanged. AMD is down, Nvidia is down, Enphase is down, Snap is down, Tesla's down, Microsoft is down, but all of these are down pretty much the way they were down this morning. Google is up, SoFi is up, Hood is down. Nothing really changed. Nothing really changed. 25 is confirmed. 25 is confirmed. 25 is completely confirmed. I'm looking at that right now. I'm looking at double sources to confirm. Yes, it is 25. I'm about to tweet it out right now. It should be confirmed. 25 is official. We got a 25 basis points hike. They raised 0.25. They raised officially 0.25. Here we go. Here we go. All right, let me tweet it out. Let me tweet it out as well. Breaking. What's the tweet? Breaking the Federal Reserve. The Federal Reserve has raised interest rates by 25 basis points. That's it. That's going to be the tweet. That's it. There's nothing exciting else to say. There's like literally nothing exciting to say. Like, oh, well, it happened. It happened. It's official. It is definitely official. We got it. All right. So the S&P is really, it's kind of going up a little bit. S&P is fine. Nvidia's fine. AMD's fine. Spotify up a little bit today. Nothing's bad. Where's Palantir? So Jerome didn't talk yet, so we're going to see what happens there. Palantir at $16.33. I'm going to open up YouTube on the screen behind me, and I'll be having Jerome talk as well. By the way, having a TV in your room feels amazing. This was a TV I got from, it wasn't in my room, and so I just brought it to my room the other day, and it's actually really amazing. Just having a screen in your room that's this big, it's like, it's just so big. It's just so big. It's just so big. That's all. It's big and it's. I'm not gonna say it. Not gonna say it. All right. So, did you read the Wall Street Journal article about the girl? No, I think I saw the headline, but I didn't read the article. I've actually started to become an avid Wall Street Journal reader, to be honest. Wall Street Journal has kind of become the thing that I've been looking to at a lot more. That's what she said. Careful, man. People can clip. I love how studios be like, careful, people are going to clip you. And then I go on Twitter and the first thing I see is him clipping me saying something in the morning stream. It's like, you know what? I would love if people clip me. Get more clips. Get me more out into the interwebs. Put me everywhere. TikTok, YouTube. By the way, if anyone has ever wanted permission to take my content and clip it up or repurpose it, you have my full permission. You can use the whole thing. Like literally, people text me like, yo, can I use it? Like, bro, just take it. It's like, well, first of all, if you were to take it, what was I going to do? Like, am I going to sue you? Is my little channel going to be like going to the United States courts, Supreme Court? Like they reclipped my, no, like it's content. It's there. It's available. So, and honestly, if you're a creator, you should want to have as much content out there from as many people as possible. So if you want to take it, then take it for free. It's totally yours. Have you heard of the ship burning next to the Netherlands? No, but I heard of the crane that fell in New York City today. I got to show you guys this thing. There was a crane that fell in New York today. It was kind of crazy. I'll look up the I'll look up the Netherlands thing in a second. So we have 30 minutes until Jerome speaks. So we're going to take a look at what's going on in the market, see what some of the other analysts are saying, and then we'll have Jerome speak, and his words will really influence a relatively unchanged market. I mean, we pretty much baked it in everything, so nothing's changing. Yeah, Wall Street Journal article notification: the Fed resumed raising rates, lifting them to a 22-year high. Interest rates are now the highest they have been since 2001. I'm choosing this stream over Kevin's. I love it, bro. You guys are lit. You guys are awesome. Thank you all for being here. All right, so this was the crane thing that happened in New York today. Let's take a little look at this. This was pretty scary here. I'm about 40 minutes from New York City, so New York City is pretty close to me.
Oh fuck.
That's kind of wild, right? If that turned into something bigger, that would have been a little bad. So hopefully, thankfully, everyone is good there. Sachin, thank you for being there. And so, yeah, that was pretty bad, but hopefully, it turns out to be a little bit more better over the next couple of days, and no one got injured. I haven't seen any reports that anyone got hurt. Hopefully it was just debris falling, but nothing too bad. Again, S&P relatively unchanged. S&P, okay, so I watched I was listening to a really good podcast today. There was a guy named Mike Wilson, okay? So let me give you guys some of the bear case for why the economy might crash in Q3 and why it'll recover in Q4. There's a guy named Mike Wilson, and this Mike Wilson dude, he's Morgan Stanley's like chief equity analyst dude. He actually got the COVID thing completely correct. So in 2020, when everyone was selling, he was buying the crap out of the market. And this was his argument. His argument was the Fed is overstimulating. They're printing a shit ton of money. All of that money is going to go down to the bottom line. Once we get inflation, companies are going to have to raise their prices. And because people have the stimulus money, they're going to be able to afford to pay these prices. And everything is going to attack the bottom line of these balance sheets. And they're going to show such elevated levels of earnings. And we saw that with YouTube and Netflix, right? Because everyone was home. They had money to pay for Netflix subscriptions, all this stuff, that earnings just went to the moon, right? It was amazing. His argument for why he didn't enter the market in the beginning of 2023, he was right about 2022 crash. The reason he didn't enter in 2023 was because he felt essentially that now when inflation decreases, prices will go back down, right? So like for example, if a MacBook costs $1,700 right now, and let's say inflation comes back down to normal, Apple can't charge $1,700 for that MacBook. So instead, that MacBook's going to be $1,650, right? $50 off the top. That magnified by the millions of laptops they sell per year across the world, that means there's going to be less earnings for Apple. They're not going to show as much money because they had to adjust their prices with the cost of inflation. That was his entire thesis for why he didn't invest billions of dollars of clients' capital into the stock market. And he also didn't see the AI thing coming, right? So he didn't see the AI thing coming. He saw inflation coming down, but he was being contrarian against inflation coming down because his argument was that that's going to be worse for prices and sales are going to decrease significantly. Now he put out a letter a couple days ago and said, look, we're wrong. We were totally wrong. We were wrong. We should have been into the markets, right? And so his argument was, even though like I was correct about inflation coming down and stuff, I missed the AI boom. I should have been investing in the markets. Here's what he said today. Today, he said there is a shot clock. If you ever play basketball, you have 24 seconds to make a shot. He says there is a shot clock on a bear market coming. He says by Q3, if my thesis doesn't play out, that decreased inflation means less prices on goods and services that companies sell, which means overall less earnings because they can't charge more for those services because the cost of capital is coming down. Inflation's coming down, so the cost of products and stuff has to come down to match with what the consumer is willing to pay. Then there's a massive bull market. So he thinks forward earnings for the S&P right now, it's like consensus 225. He thinks it goes down to 200 earnings per share of the S&P 500. And then it has a dip, and then by 2024 it gets back to 230. So he thinks it goes, we're at 225 right now, back to 200. So we see like kind of like a 10%, 15% correction. He thinks S&P to 420 is going to be like 8% correction, and then go right back up to 2024 levels at 230 to 235. Now, if this doesn't happen by Q3, if earnings don't shit the bed by Q3, then this is avoided. His argument was actually not that bad for why it's going to happen in Q3. And I mean, there is a decent case, I guess, he's making. The question is just if it's actually going to happen. And, we're going to see what ends up happening. He pulled out a bunch of arguments for why Q3 is not going to be good and like earnings are going to suffer and earnings are already suffering. I mean, one of the main arguments is the reason earnings were good in Q1 is because companies cut expenses. So when you cut expenses, of course your earnings are going to look better. If you don't have that many more employees to cut and you're not growing that much, then earnings are going to suck. And if that happens in Q3, we are going to see some pullbacks. If that doesn't happen in Q3, it's off to the races, and 2024 is going to be really fun. So we're going to see what happens. Leave the family photos up. I forgot the family photos show up on this TV. There's an opinion out there for every scenario. That is true. That is true. But that I actually wanted to listen to him today because Mike Wilson's like a legendary dude on Wall Street. He's one of those guys that, you actually do want to listen to when he talks. And so I really paid attention to his bear case and it made sense. He even admitted there's a shot clock. Either it happens or it doesn't happen. And then we'll see where it goes from there. The prices will only come down when the cost of goods sold come down. That is also a good point. And so there were some things Mike Wilson, by the way, S&P not affected at all really by the rate decision, wasn't taking into account. Like, for example, he thinks AI is a big thing, but he wasn't giving it as much credit as one might give it. Now, the question is in Q3 earnings, are you willing to give it that much credit? And maybe the answer is no, to be honest, for like AI enablement of services. But maybe the answer is yes. Wix came out with the news today. Wix is a public company. They're in Israel. I use Wix for dailypalantir.com. Wix came out with some news today that they have built a LLM, a chatbot, that basically allows you to make a website by prompt engineering. Meaning you can like type in prompts of like, oh, I want so instead of dragging and dropping boxes to make a website, for anyone who's ever built like any type of a no-code website, you'll know what I mean. You can literally be like, make the header bigger. You can type that in and then your website gets bigger. What now, does that mean like, oh my God, Wix is like engineered something amazing? No, but what it does mean is the increase in nominal productivity per entrepreneur that wants to like build a brand or start a website is just going to increase exponentially. Imagine like 30 million people that are starting a new website around the world every year that can start it instead of in 5 days, in 5 hours and get up and running and then start paying for ads to drive traffic to their website and like listing products and services. It's like, that's the overall bull case for this $4.4 trillion of AI-based enterprise value coming by 2033. It's little examples like that are just like, oh my goodness, like this is real stuff that makes people's lives easier. And so it's going to be interesting to see what happens. I use Wix for my business and it's great. I would buy the stock if it was cheaper. I actually have never looked at Wix. What's the 5-year on Wix? Yeah, I thought Wix would not. Yeah, 362 in 2021, 53 to 86. Not too bad, but it's been a year. Yeah, I never got excited about Wix. Squarespace is also public. These businesses never seem super interesting. They're like a basic SaaS business and like they're selling website space. I'm like, the other problem is if you make a website, you have to drive traffic to that website. The real value are the tech platforms that drive the traffic to the website. Like if you make a website and there's no traffic, you're going to cancel your subscription, right? So what I think has been the missed opportunities for Squarespace, Wix, Shopify's done a way better job at this because they've integrated with TikTok and Facebook, is you have to partner with platforms that drive traffic. Otherwise, people are not motivated to continue creating content for their website, which is why everyone creates content for the platforms, which is why the platforms always win. And that is the massive bull case. That is why I think Twitter at $44 billion was undervalued. Twitter at $44 billion was undervalued. I'm going to say it. I'm going to stick by that. That's my take. I think Twitter at $44 billion was undervalued. I think Elon's going to do something amazing with that platform. And we'll see what happens. What do you think of Datadog? By the way, we have 15 minutes till the Fed speaks, so we'll get into that in 15. Datadog. Okay, let's use this. I bought some new website to help me analyze stocks. So let's go to this shit and see what they say about the DD dog. Have you followed the Enovix drama today? Are you watching the earnings today? I heard there was drama, Johnny. I did not watch it. I mean, I did not pay attention to it. I know on Twitter, it was like, I checked Twitter like 7 a.m. and I saw there were some people like saying some shit about Enovix, something on LinkedIn, right? Am I getting that right? Someone liked the post or some shit. I guess we'll follow earnings with Meta after hours. We'll see what the Meta. Look, I typed in Enovix. I didn't even type in the right thing. We'll see Meta earn. I'll probably stream Meta earnings right after the J Powell thing happens, or we'll see. We'll see. But yeah, I will definitely follow the earnings. Okay, so Datadog. Net income, they are losing 24 million. They lost 24 million a quarter, so their net income is slightly decreasing, kind of flat. Revenue's going up. That's amazing. So they put up 481 million in revenue last quarter. Not bad. Price to free cash flow is 96 times. That's a little high, in my opinion. A little high. But it could be justified if we have the growth. 3-year revenue growth. Oh, 67. Okay, that's amazing. 67% CAGR every single year. That's phenomenal. 3-year revenue growth. Their actual revenue growth is 33%, which is still amazing. 33% revenue. I mean, 67 would be just like insane. 33% is amazing. They do have a decent amount of debt. That red debt line does not look the best. Why do they have 825 million in debt? Is that real? Why do these guys have almost $1 billion in debt? That's really interesting. Why do these guys? Yeah, they ended last year with 815 million in debt, 338 million in cash. Let's look at some charts. Let's see some charts on Datadog. T-Doc over Datadog. Yo, T-Doc was going up today. T-Doc was doing very well. T-Doc was doing very well. I don't know what the news was on T-Doc today, but I'm using Visual Stocks. Visual Stocks. I'm not sponsored by them. It's a friend of mine on Twitter who's building it. And, I love supporting people who are doing their own startups and doing their own things. And it's better than most of the other, ones you could pay $50-$70 a month for. It's $10 a month. It's Visual with a Z. And I like it. And I needed one because I started to use this a lot. So I was like, you know what? Let's start using it. Let's look at the line chart. Let's look at, what do we want to look at? Let's look at stock-based comp. How much are they paying the engineers to do the things that they need to do? Okay, so stock-based comp is going up. Let's do yearly. Okay, so that's not the best. Stock-based comp is going up, but again, they're in growth mode, so maybe not the worst thing in the world. Let's do revenue. Revenues are also going up pretty nicely. So last year, 2021, they did $1 billion. 2022, they did 1.6. So 30% growth, not bad at all. They're not going to be profitable, so we can see, well, that's their gross profit, not their net profit. Let's do net income. Net income. And then I want to see their debt. I don't know why their debt is as hard as it is. Yeah, so their net income is obviously negative. That green line is negative. So they're not profitable yet. They're definitely not profitable on a GAAP basis yet. And then let's look at their debt. They've also diluted a lot for some reason. Let's do a bar chart on this one. Okay, why do they have so much debt, bro? I don't understand. They're a SaaS company. Why do they have $815 million in debt? That is very confusing. This is very confusing. Can someone explain that to me? Why do they have that? Why is that an issue? Like, shares outstanding. Shares outstanding is going up a little bit. So it's going up, but not crazy. So it's like maybe like 2% dilution, which is not crazy. Yeah, I actually am curious about that. Why the hell does Datadog have so much debt? That's like, what did they do, an acquisition or something that's causing that? Because that's the one reason where I'm like, that growth is amazing, but that debt is going to be it's going to be hard to pay off. $1 billion. They're only bringing in 1.6 billion in revenue. I mean, it's not going to be the easy. I mean, it's doable, but it's like it's dampening on the business. S&P at 454, really not changed at all. Snapchat down 17%. Enphase 173. Nvidia, the Enphase options IV today got crushed. I mean, some of these options were just looking like ridiculous in terms of the prices that they were offering at. I was looking at a bunch of different Enphase prices. I mean, that's because the stock went down as well. Robinhood at $12.58. SoFi $9.37. SoFi has been doing well, staying in this $9 range, man. I mean, it's we'll see what happens on earnings, but staying above $9 has been really good for SoFi. Not been too bad. And same thing with Palantir. It's been at 16 for literally 2 weeks now. It has not gone away from $16. So it's not bad at all. By the way, I didn't tell you guys this because I tweeted about this on Twitter. Some of you guys might have seen it or not, but I had a phone call yesterday, or a Zoom call yesterday, with a fund manager in Texas. He manages $30 million. So relatively small amount by his standards. For me, I was like, oh, that's a decent amount of money. That's 30 million. It's not too bad. And he found my Palantir videos when the stock was at 7. And so he bought a lot of shares. I mean, I don't want to say how many, but he bought a lot of shares. He trimmed just a little bit, but so he's sitting on some pretty nice gains. So he wants to talk to me, get some of my opinions on some stuff. And obviously I would love to network with someone who's managing 30 million bucks. That's pretty cool. But the interesting thing that he was talking about is that he sees it, he sees it as he's been doing this for a long time. He used to work at JP Morgan for a while. He sees it as an opportunity that people don't think of it as in the AI space. And I know Palantir's hype because of AI, but the more research he's done from his perspective is he doesn't think people are really seeing what the values of Palantir. And look, it's scary to invest it at $34, $40 billion. In fact, I think after Q2 earnings, if they don't go well, we absolutely shit the bed and we come back to 10, 11 bucks. Do we go back to 7, 8? I don't think so, unless Q3 earnings hit the Q3 earnings for every company is bad. But it's kind of like buying a company at 40 billion bucks is crazy. But if I was asking about the Oracle Salesforce comparison, and again, he's been doing this for 30, 40 years, and he's starting to see the Oracle comparison make a lot more sense in terms of their trajectory, which is 300 billion, right, in terms of a market cap over the next 10 years. So take it for what it's worth. But this is a guy who manages some money. I mean, a lot of people manage money and are not the smartest in the world. So this is just one perspective, and he liked it. He thinks the thesis makes a lot of sense here on Palantir. I sold all my Palantir at 7. Yeah, well, you loaded up on Tesla, so you can get away with doing that. Datadog is $2 billion in cash, $700 million debt. They could pay it off right now. Yeah, but they're not going to do that. They're not going to get rid of $700 million in debt. I mean, they're not going to destroy their cash fund like that. So I guess it's manageable. I'm just curious, where is this debt coming from? Why do they have $700 million in debt? Maybe I'm so used to being pampered by Palantir having zero debt. But like, I get why Google and Microsoft might have some debt if they have some debt, but they have like hundreds of billions of dollars in cash. Why does Datadog have debt? What did they incur debt for? Like, what do they need the debt for? What are they doing with the debt? That's the question I would ask. Qualtrum is my favorite software for researching stocks. Shout out to Joseph. Yeah, I've never used Qualtrum, but I know Joseph's building a pretty good platform. So I actually know Joseph. I mean, we talk here and there on DMs. He did a podcast on my channel. He's a great guy, and I really respect his channel too. He's a really balanced approach. I would consider him a QQQ investor. Let's check on those, by the way. I mean, that's basically how he invests. He picks stocks that are in the QQQ. And he plays it pretty safe, but safe is still pretty good. I mean, if you're in the FANG stocks, if you're in QQQ for the year, you're up 20-30% for the year, which is not a bad way to invest. QQQ down just a little bit, 376 down 0.49% for the day. All right, so we got Jerome talking in 9 minutes. You see he's behind me here. Now the question is he going to be overly bearish to make sure he has flexibility, or is he going to be a little bit more dovish? And that's where we're going to see the market react in real time and kind of basically decide for us where we want to take it or where we think it, might not be able to go. Let's take a look at, let's get a little bit of actually coverage on Microsoft as well. Microsoft is down today on earnings because it ran up a little bit, but Microsoft probably going to be one of the main beneficiaries of AI. So let's take a look at a little bit of Microsoft. Is at 343 right now. We'll see where it goes as J Powell talks.
Microsoft on the move following quarterly results. Both companies beating analyst profit and revenue estimates, but Microsoft now down on weaker than expected revenue guidance. AI, obviously a very big focus for both of these companies. That term was mentioned, are you ready for this? 145 times on yesterday's earnings calls. Joining us right now is Brent Thill, Jefferies equity research analyst. Good morning. If you could buy one or the other, which one do you take?
We like Microsoft here.
And it's interesting because I had someone on the morning stream today say they like Google. So you see the divergence of opinions here.
For the long term in AI, the stock's going to be off based on the AI tidal wave coming. There's no revenue yet, so everyone got a little ahead of their ski tips on the impact of AI in the short term. But the long term, there's no question they have the best monetization, the best partnerships, some of the best technology, and they've already unveiled the pricing models that you can see that you can start to layer in the model going forward. So revenue growth should accelerate. You continue to see support for their Azure business. All their product lines will be infused with a Copilot, and this is hurry up offense. This is not the old Microsoft. They are not at a risk of actually confusing some of their customers. They are coming with a flood of products that I thought that may confuse customers, but talking to Microsoft last night, they are literally ready to roll. They are not going to hold back, and there's going to be a flood of AI solutions that their customers can pick from that will drive revenue and margin.
Let's take a look at this. So obviously, yeah, I mean, the Microsoft thesis makes a lot of sense. We'll see where J Powell sends it. Here was the actual report by the Federal Reserve. So this was a little bit reading off from the press release. We got about 5 minutes till Jerome speaks. Recent indicators suggest that economic activity has been expanding at a moderate pace. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated. The U.S. banking system is sound and resilient. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. The committee remains highly attentive to inflation risk, so they still do not think they have dealt with the existential catastrophe in our modern times that is high inflation. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. In support of these goals, the committee decided to raise the target range for the federal funds to 5.25 to 5.5. The committee will continue to assess additional information and its implications in determining the extent of additional policy affirming that may be appropriate to return inflation to 2% over time. The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation and economic and financial developments. In addition, the committee will continue reducing its holdings of treasury securities and agency debt. So a little bit more of quantitative tightening in agency mortgage-backed securities as described in its previously announced plans. The committee is strongly committed to returning inflation to 2% objective. This is basically what J Powell is going to say in the first 10 minutes of the call. He's going to reiterate pretty much everything they're talking about in the press release. Last sentence, the committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures, inflation expectations, and financial international developments. If we go to Trueflation, inflation has ticked upwards. It was 2.4 yesterday. It's 2.51. So we see a pretty obvious tick upwards. Does this mean headline CPI next month is going to be upwards of 3%? It is possible. It might not be the worst thing in the world because you don't expect in 2023 or even 2024 for inflation to be down at like 0.5% or 1%, right? You kind of expect it to struggle a little bit near the bottom. Now, granted, the bear case for Q3 is that inflation ticks up, the market sentiment changes, Q3 earnings shit the bed, and boom, we're at S&P 4,000. And we might struggle with that all into end of 2023 and then 2024, see a little bit of the rebound as everything comes back down, which might be a really, really amazing dip opportunity. Or inflation cools down by September, October, and there's not this aggressive market sentiment change. Earnings are fine. And, things kind of play out the way they need to play out. So a lot of different ways of seeing this happen. But this is, kind of where we at with inflation. It's almost same word to word from the June FOMC statement. Yeah, there's not that much different from the June one as well. Thought I had playback speed of 1.5 on with how fast you were reading that, Amit. I'm a talk faster. I'm a fast talker. There's 9.3 thousand people waiting for the CNBC J Powell announcement thing. 9,000. So guys, there's 9,000 people right now across the world, including the 384 that are here. Thank you so much for being here. That are all waiting to see this one guy talk. This is what we're waiting for. We need him to say something, and that's going to affect everything. Now, in the grand scheme of things, whatever he says doesn't really matter for most of our portfolios long term. Like, it really doesn't. But life is about the journey. And this is kind of a conclusion I came to. Like you may ask a philosophical question, like, why does it matter paying attention to the stock market, right? Because at the end of the day, if you're not going to sell for a long time, you just kind of, you let it play out. You go do other things. But that's not that fun. Like, why do you care about watching sports? Like watching regular season till the postseason? It's because the regular season builds up to the postseason. So to me, these moments in time are just moments where we all get to come together as a community and try to come to some rationalizations of what's going on, even though it's inevitable what's going to happen at the end. And then if you really want to get existential, what's the point of living? Because we're all going to die at the end, but like the whole point of living is the journey, right? So I think it actually makes sense to get excited for these moments if someone says that being excited for this moment doesn't make sense. That's kind of my take on it. Does Amit talk fast? Yes, it's the coke. I've never done cocaine. I've never done it. I wonder if J Powell's done cocaine. Bro, could you imagine J Powell being high? He should be talking in about 2 minutes. Could you imagine him being like, let's just say someone slipped him a brownie and like before the meeting, he's like, oh, a brownie. This is great. I need to get my blood sugar up a little bit. And then he's high as fuck. Bro, I couldn't imagine. Like, could you imagine him just high in this meeting trying to get through these questions? And they're all asking shit. And they're like, why is inflation? They're like, do you think inflation's high right now? And he's like, I'm high right now. You think inflation's high? 2.51%? I'm on cloud 9. I'm 9% right now. That would be crazy, bro. That would be wild. He panics and runs. What other earnings did we have today? We have Meta and Novix. What earnings did we have in the morning? Does anyone, let me go to the earnings. What earnings did we have today that were important? There wasn't any super big tech in the morning. I may, if the junkies are coming. Yeah, we'll talk about Enovix today at 7 p.m. What other earnings do we have today? Earnings. I think we had a couple of banks this morning. Did we have some banks this morning? We had no, I'm looking at tomorrow's. Tomorrow's going to be Hershey's. By the way, you know that guy who said short Palantir? He said to short Hershey's. Oh, we have Chipotle today. He said to short Hershey's because of Mr. Beast. He might be right about that. I thought the thesis was a little interesting. But so we have Chipotle today. ServiceNow, that's a big one. Enovix, obviously. eBay is reporting today. Okay, eBay is going to be interesting. Lending Club, that's a fintech. We're going to have to think about that one. IMAX is a public company. So I'm watching Oppenheimer today, by the way. I'm taking my sister at I'm gonna have to leave fine. It's a little early, but I'm taking her to see Oppenheimer. Is IMAX a public company? That's crazy. Artist here, you're a madman worker. I appreciate the $5 super chat. Thank you so much for the $5. IMAX is a public company. IMAX public stock. Yeah, it's a company. Wow. I didn't know they were public. $17. That's their stock. Meta today. Meta is today. Johnny, I'm looking at Earnings Whisper right now on Twitter. So I was already looking at it, but thank you for that. Oh yeah. You and I were looking at the same thing. So looking at your photo, you have end phase circled. Of course, Johnny has end phase circled on it. So we have end phase tomorrow. That's going to be a big one after hours. We have Ford, Roku. Bro, I was looking at Roku charts. Kathy, it's like her number one position. The growth is not there for Roku. I don't know what they're seeing on Roku. The growth is literally not there. Like it's just not there. And they're not profitable. So I don't know what I was trying to see if does Kathy have a thesis, because I was thinking Aleo is ARK a little bit interesting right now, and then I looked at the holdings, then I saw Roku, and I was like, all right, let me look into Roku, and I was like, goodness gracious, like they have $1 billion in it. Imagine they just put $1 billion into Google in the beginning of the year, or fucking Nvidia or anything other than Roku. Like take the losses on Roku in January and just dump it into Palantir. They would be up so much on it, but they're sticking with Roku. We have McDonald's tomorrow. Crocs, MasterCard. Okay, here he is. He's talking.
Dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy is of monetary policy. Today, we took another step by raising our policy interest rate 0.25 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Steve.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting. And as we go into each meeting, we're going to be asking ourselves the same questions. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path but it will be consistent with the CPI reading, but we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture, and starting with we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. We'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting. And
he basically said it's depending on the data. That's it. He's like, it depends on the data, and that's it, which is what we expected. Not too hawkish.
You know, how we're thinking about meetings going forward potentially, but you know, we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity.
S&P's up 456. S&P is absolutely going up. It likes it.
All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period, it broadly came in line with expectations. Great. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Gina.
Thank you. Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. We've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder, from your perspective, if that continues, if we see growth not just stabilizing, but performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy overall.
This is great, bro. He is being the most dovish I have seen. He's basically saying, look, we've raised it a ton. I know we've raised it a ton. I'm acknowledging we've raised it a ton. The economy is being pretty resilient. The fact that inflation is coming down without this crazy hard landing means that, yeah, we might not have to raise it anymore. That's all the market needed to hear.
That's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Neil.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS look good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations. And as a result, we went ahead and took another step. And that's, a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but we're going to be careful about taking too much signal from a single reading. And growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter, and that by September, that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything. And, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data. And
He's like, look, buddy, I don't know. We'll see in September. But that's all the markets wanted to hear. Now, if he was being aggressive, he was going to be like, look, no matter what happens, we're definitely raising. He wouldn't say that, but you could tell by the tone of how he was saying that the market would be tanking. He's not doing that. Wow. The market's going up a lot right now. The market is loving this. He's basically saying, look, it depends on the data. That's all I can say. It depends on the data.
that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you were really, sorry, what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3%?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the 2 risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But, we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think core is signaling where headline is going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3% or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And, we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the the longer term social costs of failing to do so are greater. And that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity. And, that's the thing we really need to avoid and will avoid.
Guys, we have some breaking news. Robinhood has raised their APY from 4.65 to 4.9% for uninvested cash. And they announced this 40 minutes after the Federal Reserve raises rates by 25 basis points. So they're saying, look, instead of giving your money to the Fed and getting 5.25, you can put it in Robinhood, get basically the same at 4.9, and get all the amenities of what Robinhood is offering. So we're seeing companies react to the basis point announcement almost instantaneously after the Fed has made the decision. Robinhood now at 4.9 basis points, 4.9 APY.
Michael McKee.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think, today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Colby.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down, the point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think it'll sort itself out.
Howard.
Thanks. Howard Schneider with Reuters. So among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy. And there are those who feel, they say it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags plural that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract
That's
the
bullish
estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so.
That's bullish.
So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data. And given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is, the growth rates edging down towards and heading below zero, which is usually a recession indicator.
So I guess the SLOOS will come out early next week, and I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source. But I think what matters is the overall picture is of tight and tightening lending conditions. And that's what this SLOOS will say.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So interesting question. So let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from both from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing. And the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. Take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
See. And just to follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said input.
Yo, that guy complimented his choice of tie just to make everyone feel good about how Jerome Powell was not hawkish. We've got S&P at a 52-week high. S&P right now is at 456. Yeah, that's 52-week high, or that's very close to 52-week high. So obviously, yeah, we just passed it. We're just under, so we passed it just for a little bit today. 456, S&P is up. Market likes what we're seeing from Jerome.
Cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
This is a good question.
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there, and by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey has, it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike. And the common thing is they come out with agreements like big pay increases like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations, not our job, not our role. We monitor these things and we'll keep an eye on them, but really that's something that's handled at that level and not
a large amount of people.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates? Or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on a wide range of things. And when people are writing down rate cuts next year, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we would.
Bro, why do they ask this shit? It's like he's not answering that.
We'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would
Oh shit! He just said we're not cutting rates this year. Hold on.
But many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2%.
Okay, perfect. So what he just said, I just saw the market tick higher. He said many people thought we would have several rate cuts next year. It's not off the table. We're just going to have to see the data depend on what's going to happen. Now, if he said rates are definitely not getting cut next year, something like that, which he wouldn't say because for the past 30 minutes he's been relatively dovish, then that would be bad. But that's not what he said. He said in his last couple minutes that he's talking, we'll see next year. We might have to cut rates next year. It all depends on the data, which is all that matters. As such, and says, yes, no longer forecasting a recession. That didn't surprise me, but you never know. Sometimes he says something and the market immediately interprets it. But it seems like it makes sense what he said, the way he said it.
Cool.
Steve.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for recession. And I'm wondering if the staff has changed its view on the likelihood of recession being likely, and if you personally have changed your view in
This is a good question. Let's see.
terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view. And I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we as FOMC participants produce. Having an independent staff forecast as well as the individual participant forecast is really a strength of our process. There's just a lot of I think constructive diversity of opinion that helps us make informs our deliberations, helps us make I hope better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say though that there's a pathway, and yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical record suggests that there's very likely to be some softening in labor market conditions, and consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which is
Okay, markets just went down. S&P back to 454, so it gave up all of its gains. I'm confused why. Anything you guys heard that was really there? Let's see if it pulls back up, but markets just dumped just a little bit right now.
Which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy. And we hope it continues.
Jeff.
Thank you, Mr. Chairman. Jeff Cox from CNBC.com. You and other Fed officials in the past have suggested that you don't need to keep hiking until inflation hits 2%, that as long as you see continued progress. So I'm wondering, how close do you need to get with the inflation numbers coming down? How many months?
See that? I guess it's the optimist. He has simply said that inflation is going to take longer before tamed, and it may take even till. Oh, he did. He said it may take till 2025. Okay, so the markets tank on that news, but does anyone believe him that it's going to take another year to get back to 2%? I think. Yeah. All right. Well, yeah, he tanked it. The S&P is not at the highs anymore.
Of data do you need to see that will give you sufficient confidence? And how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So in effect, if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt. But people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make. I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until all the way back to 2 until 2025 or so. So.
Oh shit! I just noticed that it's delayed. That's why I'm here now. Okay, so let me go back to. I'm 9 seconds back. Let me go back, or like 30 seconds back. Now it's officially live. That's why I missed it.
Real wages are positive again. That's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down, and that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control. And we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle class people have some resources and can absorb inflation. The people in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we take too long or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event the market had assigned a roughly 99% probability to the rate move that you announced today, the decision was, of course, unanimous. And the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, I mean, you could. Was there doubt? Look, I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that there's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks, the dollar, the stock market, et cetera. What does that mean for the Fed and being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, we're of course very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down. And in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing. And ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could happen. The question is, is that consistent with? So if you think about both of them as normalization, imagine it's a world where things are okay and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT. So to continue it, you depending on where you are in the cycle. So they're two independent things, and really the active tool of monetary policy is rates. But you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Go to Kyle.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it. Thanks.
So that's a very important thing. Yes. And yes to both sides of that. Yes, banks are now working to see that they are ready to use the discount window, and we are strongly encouraging them to do that, banks broadly. We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Let's go to Mark Hamrick.
Mr. Chairman, Mark Hamrick with Bankrate. You've talked in the past about getting the housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance or lack thereof right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all of that happening with the 30-year fixed rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now, and there are people coming in. A lot of the buyers are first-time buyers coming in at buying it, with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the aftermath of the pandemic.
We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so looking at what we know now.
Thank you.
Thanks very much.
All right, there we go, ladies and gentlemen. That was Jerome Powell speaking in the July 26th FOMC meeting. We're about to take a look at some of these markets. Overall, meeting was pretty dovish. He said a couple of things at the end that got the markets a little upset, primarily this whole idea that interest rates are not, or that inflation is not going to be done by 2025. But to be honest, he's been saying that for a while. See, the paradox in all of this is that for the past 7 months, Jay Powell has been saying we're not going to cut rates till 2025. Inflation's not going to get to 2% till 2025. We've all known this. The problem is the market hasn't believed him. The market has not believed him. And so every time the market dumps when he says it, it's kind of ridiculous because we don't believe him. We know inflation is going to be below 2% or at least at 2% in 2024, causing a rate hike, which is why he did do a good job saying a lot of things essentially around the concept of optionality, of essentially making data-driven decisions, almost sounding like Palantir, basically saying, look, when we get the data, we're going to make decisions, and acknowledging that consumer confidence is good, the economy is doing well. He's acknowledged we've raised rates a significant amount if you look at it on a nominal basis, which means he agrees that monetary policy has been restrictive enough, and he didn't sound like it needs to get overly restrictive to get to that 2% inflation target. But at the same time, he also said he doesn't think inflation is getting to 2% till 2025, meaning they could pause for all of 2024. And that's not going to be good for stocks. I mean, we cannot have a sustained pause for a year if we want the S&P to, get to really, really nice levels and really have a good bull run. I mean, like, it's just not possible to have it for that long. So I do believe they're going to cut. They just need to see more data. And honestly, that's just going to take a couple of months for them to be able to get that data. And then we'll see. S&P is down at 454. It was at 456 all-time highs, 456.98. You see right there that green candle. Now it's back down. There's that massive red dump it just took. So S&P coming down. Spotify is up a bit, bouncing from yesterday. Nvidia is down. The Qs most likely are down. Yeah, Qs are down. You see that massive red candle right there. So the markets liked it, but the markets didn't like it enough based on the last couple things he said. But again, those last things he said it doesn't make sense to dump on that. The markets are just doing what the markets are doing because he's been saying that for months. I guess if he had said, look, maybe inflation is going to be at 2% by 2024, we would be even higher because that would be a change in what he has said for the past couple of months. But he wasn't going to reiterate that or give the markets any benefit of the doubt and let them assume that that was going to be the case. SoFi at 939. Robinhood announced 4.9% APY right after the Fed decision. Now Robinhood at $12.71. Their earnings are going to be on August 2nd. Meta at 298. Meta is going to be reporting in about 40 minutes. S&P at 454, Spotify 147, AMD 110, Nvidia 453, Enphase 172. Enphase took a dump today, but recovering just a little bit. Nice little green candle right there. Microsoft at 335. Microsoft has not been able to recover the day, but it was at 369 a couple of days ago. So being at all-time highs, you expect it to come down going into earnings. Has Google sustained the 6% rise? Google, yep, nothing has tore down Google today. A little bit of a red candle from 129.66 to 129.27, but overall, Google maintaining 6%. They added about $100 billion worth of market capitalization today to their company. Not bad at all for Google. SoFi needs a good $15. It needs a good earnings, and then it'll get there. But it needs a good earnings. And even if earnings are good, it might sell off. So that's why I'm a little... SoFi needs to kill it out of the park. I mean, SoFi needs to do amazing, and I don't know if they will. So we will see. If they can get GAAP profitability or really close, I think the market's going to give them some love. But they can't just have a triple beat. They need to have something extra there. They were adjusted by... what was the name today? what was the name today of the company that Jefferies upgraded them to 1150 from 950. So Jefferies gave them an upgrade as well, which is not bad. The Qs took a poo and the VOO took a poo. Yeah, all the indices came down just a little bit more today. Okay, not bad. Not bad. Amit, are you going to cover Enovix today? So I'm going to leave right now. I got to get into a couple of different things, but on Finance Junkies, we'll cover Enovix and Facebook at 7 p.m. So I'm not going to be covering it live, but we'll talk about Enovix at 7 p.m. and Facebook at 7 p.m. as well. And we'll see kind of where the markets go from there. All right, that's it for me, everyone. Overall, not a bad rate hike by Jay Powell. We expected it. Overall, sound dovish. Little comments at the back end that sounded a little hawkish, but more so just speculative. And hopefully the markets will recognize inflation is coming back down to normal, and we'll see where we can go over the next couple months. Not bad. That's it. All right. Thank you all for being here. Really, really appreciate it. Please make sure to like and subscribe. Would mean the world to me. Follow on Twitter. Twitter's in the description. And I'll see you guys at 7 p.m. for Finance Junkies, and we'll talk about Enovix, the Fed decision, and Meta earnings. Thank you, everybody. See you in a little bit.